Hey everyone, welcome back to the channel. Today, we're diving into a critical financial issue that's sending shockwaves through the global economy. Japan's desperate attempt to manage its debt and interest rates has reached a breaking point, and the consequences are far-reaching. Buckle up because this is going to be a wild ride. In this video, we'll break down the dramatic situation unfolding in Japan's financial sector. We'll explore the staggering amount of debt the country has accumulated, the impact on their economy, and the broader implications for global markets. We'll also look at how Japan's currency crisis is affecting everyday people and industries and what the future might hold. This is Earth Economy Explained. Japan has been in a low-level but escalating financial conflict. The central bank has been frantically issuing trillions of yen in bonds to keep interest rates down, but this strategy is nothing more than a desperate measure. The Bank of Japan now holds over 50% of all outstanding government debt, nearly 600 trillion yen. This is a massive gamble that's starting to backfire. The critical problem with financial engineering is it doesn't work long-term. Sure, you can suppress rates temporarily, but it comes at the expense of the currency. The yen is collapsing, and even the Bank of Japan is admitting the crisis. The new currency chief has made a startling admission. The demerits of yen depreciation are becoming too obvious to ignore. Japan's consumer base is being decimated as people cut back on spending due to shrinking purchasing power. Look at this chart. While nominal wages in black have gone up slightly, real earnings in blue are negative. This means that despite higher salaries, the average Japanese worker is losing buying power every single month. The collapsing yen is also driving up the cost of imports, forcing families to spend more on basic necessities like food and utilities. The argument that a weaker yen boosts exports is falling apart. Japan isn't rich in natural resources and relies heavily on imports. June's factory output crash by 3.6% proves that a weaker yen isn't making exports more competitive. Companies like Toyota are struggling with global output down 13.3% for 5 consecutive months. Japan's central bank is now signaling a pivot. They've hiked interest rates to 0.25%, their second increase since 2007, and plan to cut bond purchases by 50% by 2026. But this move is more symbolic than effective. Japan has essentially surrendered to higher inflation, admitting they can't outlast the Federal Reserve's high rates. The yen's collapse isn't likely to reverse anytime soon. From now until then, we should anticipate Japan to continue dumping US dollars to prop things up. Since September 2022, Japan has intervened in the currency market at least 4 times. In March of this year, they raised interest rates for the first time, yet the yen continued to slide against the US dollar. There's no reason to suppose the recent recovery is a major reversal. Until then, the BOJ will burn 50, 60, or 70 billion more to sustain the currency. The Fed must still lower interest rates in order to achieve long-term change, but doing so will be detrimental to the US economy since Japanese investor money may leave the country and return to yen assets, and they might ignite a nasty sell-off. The real solution, as admitted by Japan's new currency chief, is to improve the economy. Financial engineering can only go so far. Japan faces intense competition from China, especially in the auto industry. Most households throughout the world can only afford one vehicle, so if they don't buy a Japanese brand, they're likely to get a Chinese car. Thailand is now experiencing a manufacturing war. The New York Times sums it up perfectly. Japan established Thailand's automobile industry. China is hunting for it. Japan names such as Nissan, Mazda, and Honda previously dominated Southeast Asian markets. They're all household names, but China is one step closer to swallowing Thailand's auto market. They are taking market share away from Japan, which is quite worrisome. Japan's big pop stars will vanish during the next 5 to 10 years. Today, it still holds a stranglehold on the Thai car market. In 2022, 85% of vehicles sold were from Japanese brands. However, by 2023, this figure has decreased to 76% in just 1 year. At the same period, Chinese brands increased their representation from 4.7% to 10.3%, more than doubling vehicle sales. It's all about the rise of electric automobiles. It's critical to grasp grasp the speed of Chinese automakers. When they recognize a market opportunity, they go all out, which is not common in Japan or Germany. Just listen to the narrative. It's simply amazing how quickly China can operate. JAC-AN is a Chinese automaker, and when they arrived in Thailand, they had no idea. This is a bizarre story. They had no offices, factories, or employees. They set up shop in a hotel and worked from conference rooms. They had meetings in the lobby. They worked around the clock to recruit local dealers. They sold their first electric vehicle in Thailand in 74 days, or around 2.5 months after arriving. This is not the exception. It's the norm in Chinese businesses. It's astonishing to learn of Japanese brands fighting against China, and this is from the CEO of Sony and Honda's joint venture, a firm that makes electric automobiles. Japanese automakers are highly concerned about China's rapid EV development. Japan's rigid corporate culture just cannot keep up. They're moving too slowly. And here's the final nail. The development period of Chinese EVs from conception to production has been reduced to as short as 18 months. So Chinese manufacturers can produce a new EV model in half the time it takes their Japanese competitors. There's simply no way to compete at this price. While it is true that Chinese EVs cannot enter the US, but Japanese exports can, this is pretty useless. When it comes to the global market, Japanese automakers cannot hide behind a wall of tariffs. Doing so would ruin their competitiveness, as they would be fully dependent on the US economy and consumer market. In December of last year, Thailand's Prime Minister advised Japan to wake up. Please wake up and make faster decisions about whether to manufacture EVs in Thailand or not. You are not alone in this planet. And it was the warning. Obviously, Japan did not take it seriously. As China moved in, they swooped in and ate their meal. It's going to be a large supper. Chinese EV players already have a presence in Thailand. BID, for example, produces 150,000 automobiles each year. Sion currently produces 50,000 vehicles. In total, we ship about 800,000 pieces per year, the majority of which are for the Thai domestic market. This figure is expected to rise even further. The EU tariffs did not come into effect until a few months ago, and it is clear that the Thai government is pushing for green initiatives, including in the auto industry. By 2030, 30% of cars produced in the country will be zero-emission vehicles, also known as electric vehicles. This includes domestic battery manufacturing, so you have a country that wants to shift to electric vehicles, and demand will range from zero to the moon, and it becomes easier to encourage EV adoption. Thailand is also providing numerous subsidies to reduce the cost of domestically manufactured electric vehicles. Buyers can collect up to 100,000 baht each car until 2027, which is roughly $3,000. The BID Auto 3 in Thailand costs less than 900,000 baht, so you're offering folks a refund of more than 10% off the sticker price. This will lead to increased adoption, can make EVs even more affordable than some combustion vehicles. It's a no-brainer that the market for ICE vehicles will fall over the next several years, particularly in Thailand, because Japan is lagging behind. Certain automakers such as Suzuki are closing their plants, which is quite distressing. The Suzuki facility began production in 2012, producing ICE vehicles for both the local Thai market and exports, so the company has a year on the ground. They understood the EV market was about to explode. However, they did not turn quickly enough, and this is affecting many Japanese businesses. Honda and other major manufacturers are likewise reducing production and attempting to transition to electric vehicles. But are they able to pivot now? Sure, yes, they can. However, creating supply networks and just reorganizing existing plants will be extremely costly. Thailand offered Chinese manufacturers a terrific deal, a $4,000 grant each EV manufactured in the nation. Will the incentives be available when Japanese automakers make the transition? Chances are no. Japan is now dealing with numerous difficulties. Their currency fell. Losing the EV market are simply symptoms of a larger issue. They're avoiding reality and the larger picture. So, what's next for Japan? Can they turn the tide and reclaim their economic stability? Will their rate hike make a difference, or is Japan doomed to struggle against China's relentless advance? Thank you for watching my take on this critical news from Japan. Share your thoughts in the comments below. If you found this video insightful, please smash that like button, subscribe, and hit the bell icon to stay updated. As always, stay safe and stay informed. Thank you for watching Earth Economy Explained.